Welcome to the deep dive. We're all about, cutting through the noise and getting to what really matters in financial reporting.
Exactly. There's just so much information out there.
Totally. And if you're trying to get your head around complex accounting stuff, or maybe you just want to be sharper when looking at company financials, well, today's deep dive is definitely for you.
Mm-hmm.
We are tackling supplementary information audit reports. It sounds a bit technical, maybe, but it's actually a key part of understanding annual financial statements.
It really is. Often overlooked, I think.
Yeah, think of it like peeling back another layer of the onion,
Yeah.
getting closer to what's really going on financially. Okay, let's unpack this.
Let's do it.
But first, before we dive deeper, a quick reminder that this podcast is based on material from Farhat lectures.
Right.
All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com.
A really valuable source.
Absolutely. So whether you're an accounting student, CPA candidate, or professional, definitely visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic.
Mm-hmm.
And a special thanks to Professor Farhat for providing this valuable material.
Indeed.
Okay, so diving in. When we talk about financial reports, we hear these terms thrown around. Supplementary information is one. What is that really?
Yeah, it's a good question because it can get confusing.
Right. How is it different from, say, other information or maybe required supplementary information? Feels like a bit of a jargon jungle sometimes.
Oh, absolutely. You can feel that way. So let's clear the air. Today, we're focused specifically on supplementary information, or SI.
SI, got it.
Think of it as optional bonus content, stuff a company chooses to include. It's information presented in addition to the core financial statements, the income statement, balance sheet, the usual suspects.
Okay, so it's extra, not part of the main event, so to speak.
Exactly. Now, you mentioned other information that's a much broader bucket. Could be the CEO's letter in the annual report, maybe a press release, stuff that isn't necessarily pulled directly from the accounting records in the same way.
Ah, I see. Less structured, maybe?
Kind of, yeah. And then there's required supplementary information, RSI. That's different, again, because it's actually mandated by accounting standards for certain things.
Oh, okay. Like what?
Things like pension plan details for some companies, or oil and gas reserve information. Stuff GAAP or IFRS says you have to disclose separately. We can definitely dig into RSI another time. It's interesting too.
We should.
But for today, the key things about SI are it's voluntary, it's extra, and this is important, it can be audited.
Okay, that voluntary but audited part.
Yeah, that's interesting.
Why would a company choose to add extra stuff and pay an auditor to look at it? What's the thinking there?
That's the million-dollar question, right? The main reason is to provide additional information for analysis.
For users, you mean? Investors, analysts?
Exactly. Imagine you're looking at, say, a tech company's R&D spending. The main income statement gives you one big number.
Right, just the total.
But supplementary information might give you a schedule breaking that down. Maybe how much went to software development versus hardware or specific big projects. It could reveal a major bet on AI, for instance.
So it gives context. Much more detail than just the main number.
Precisely. It's not just more data, it's often the strategic context that helps you really understand where the company's going. It lets you see if they're spending wisely, not just spending a lot.
Okay, that makes sense. And the audit report for this SI, is it always separate?
It can be. Sometimes it's a completely standalone report just on the SI. Other times it might just be a separate paragraph added within the main audit report on the financial statements themselves. Depends on the situation.
Right, so it gives analysts more ammo, basically.
Yeah.
But you said an auditor can audit it. Does that mean sometimes they can't? Are there restrictions?
Absolutely, and this is a really critical point. An auditor cannot audit the SI if they've already issued an adverse opinion on the main financial statements.
Adverse meaning
Mm-hmm.
the main statements are bad.
Right. Adverse means the auditor concluded the main financial statements are materially misstated and don't present fairly. Or they can't audit SI if they issued a disclaimer of opinion.
And disclaimer means?
Disclaimer means the auditor couldn't get enough evidence to even form an opinion. Maybe there were major scope limitations.
Okay.
So think about it logically. If the core financial statements are fundamentally unreliable, Or the auditor couldn't even say if they're reliable.
Then auditing extra details doesn't really help anyone.
Exactly. What value would there be? It would be pretty useless, maybe even misleading for users. So no SI audit in those cases. But if the main opinion is unqualified, meaning clean, or even qualified, that's fine. Auditing the SI is acceptable then.
Okay, that makes sense. Adverse or disclaimer on the main statements, no SI audit. Otherwise, it's okay.
Correct. And one other crucial thing. All this supplementary info, whether it's numbers or descriptions, must be derived directly from the underlying accounting records used for the main financial statements.
So it has to tie back.
Directly. And it has to cover the exact same reporting period. You can't have SI for Q1 tacked onto full year financials, for example. It has to be consistent.
Consistency.
Right.
That makes perfect sense. Okay, to make this really concrete for everyone listening, could you maybe give some real-world examples?
Yeah.
Like, what would this actually look like for a company we might know?
Sure, good idea. Let's take a well-known company like Tesla, just as an example.
Okay, Tesla.
Imagine you look at their income statement and there's a line, maybe other expense or income, and it shows, let's say, a $122 million loss. Just one number.
Pretty opaque.
Exactly. Supplementary information could be a detailed schedule that breaks down exactly what's in that $122 million. Maybe it's losses on foreign currency exchange, maybe write-offs from some small side ventures they shut down, details you wouldn't even get in the regular footnotes. Okay. Way more granular.
Much more. Think of it like this. The main financial statements are like the vital signs on a patient's chart: temperature, pulse, blood pressure, gives you the critical overview. Supplementary information, that's like the detailed MRI scan or the specific lab results. It drills down into one particular area to show you why the pulse is high or what's causing that weird reading. It's the deeper diagnostic.
I like that analogy, the MRI for the financials. So it's this super detailed look at something that was just a summary number before. It really completes the picture, doesn't it?
It really does.
But I wonder, does that level of detail ever risk just, overwhelming the average person looking at the report? Or is it really aimed at specific people?
That's a fair point. And yeah, for someone just glancing at the headlines, it might be too much. TMI, perhaps.
Right.
But its real value shines for specific users. Think sophisticated investors, professional financial analysts, maybe creditors doing deep dives, or even a company thinking about an acquisition. They need that granular detail for due diligence. The power users, basically.
Exactly. It gives them the raw material to plug into their own complex models and forecasts. Like, sticking with Tesla, maybe they're selling general and administrative expenses. SG&A is a huge number, say $3.1 billion.
Okay.
SI could give you a breakdown. How much of that was marketing? Stock-based compensation, rent for showrooms, executive salaries, much more detail.
Gotcha.
Or on the balance sheet side, maybe a detailed breakdown of property, plant, and equipment, showing different categories of assets, their values, maybe even locations. It gives real insight into the company's asset base.
So really any kind of expanded table or detailed schedule that drills down on a line item. Or even statistical data pulled from the financials.
Precisely. As long as it meets the criteria of voluntary, derived from the same record, same period. And the why is always to give those users more detailed and, importantly, audited information for deeper analysis and understanding.
Audited is the key word there, adding that layer of credibility. Okay, this is much clearer now. So let's switch gears a bit. What does this all mean for the auditor then? What's their specific job when they're asked to audit this SI?
Right. The auditor's role, their core responsibility, the main objective, is to determine whether the supplementary information is, and here's the key phrase, fairly stated in all material respects in relation to the financial statements as a whole.
Fairly stated.
Okay.
In relation to the financial statements as a whole.
Okay, that sounds important.
It is. It emphasizes that this extra detail can't just be floating out there. It has to align with and fairly reflect what's in the audited main statements.
Got it. So the audit report itself, the one on the SI, what does it typically say?
Well, it usually includes specific language. It'll state that the information is presented for the purpose of additional analysis.
Okay, clarifies the why.
Right. It'll also say it's not a required part of the financial statements. Makes that distinction clear.
Voluntary, like we said. Exactly. And crucially, it states it's the responsibility of management. The auditor audits it, but management prepares it and owns it.
Management's responsibility. Good distinction.
The report also notes that the information was derived from and relates directly to the underlying accounting and other records used to prepare the financial statements. Ties it back to the source.
Right, that derivation point again.
And finally, it says it has been subjected to the auditing procedures applied in the audit of the financial statements and certain additional procedures.
Ah, okay. Certain additional procedures. That sounds like where the specific SI audit work comes in.
Mm-hmm.
What are those extra steps the auditors take?
Yeah, those additional procedures are designed specifically to test the SI itself and make sure it's reliable. Think of it as targeted testing.
Okay, like what?
Well, first off, they're comparing and reconciling, literally tracing the numbers in the SI back to the company's detailed accounting records and making sure they match the figures used in the main financial statements. Checking for consistency.
Playing detective, basically. Making sure the stories match.
Pretty much, yeah. No creative accounting allowed in the extras either. Then they'll make inquiries with management, asking questions like, why did you decide to present this specific information? How exactly did you prepare the schedule? What methods did you use?
Getting the backstory.
Exactly. And related to that, they need to understand any significant assumptions or methods management used in preparing the SI, especially if there are estimates involved. Are those assumptions reasonable?
Because estimates can be subjective.
Very much so. They also need to evaluate the completeness of the information. Is anything important missing from this supplementary schedule that, if included, would change how a user understands it?
Making sure it's not telling only part of the story.
Right. And finally, they obtain written management representations. This is basically getting a formal letter from management confirming they're responsible for the SI, that they believe it's fairly stated, and acknowledging that the auditor's report on it will be issued.
So management has to formally sign off on it.
Yes. It's about making sure everyone's clear on responsibilities and that the information meets the criteria for being audited alongside the main financials. It's about building that bridge of trust, between the company's detailed data and the user.
That's a pretty thorough process. Comparing, inquiring, understanding methods, checking completeness, getting reps. It really ensures the SI is reliable if it passes muster.
That's the goal, to provide that assurance.
This whole discussion really changes how you might look at an annual report, doesn't it? Makes you think about where this extra info comes from and, well, how someone could really get a solid grasp on all these concepts.
Absolutely. And, for anyone listening who does want to really master these kinds of concepts, maybe you're studying for the CPA exam or you're an accounting student, the type of detailed explanations and examples we've covered today, along with things like practice questions, multiple choice, true, false, video lectures, they're all available at farhatlectures.com. It's a really comprehensive resource designed to help you embed this knowledge properly. Different ways to learn it, basically.
Okay, good to know. So for anyone wanting to go deeper, the resources are definitely out there, farhatlectures.com. And for you, our listener, just wrapping up here, here's maybe a final thought to chew on. We've unpacked this idea of voluntary supplementary information, this SI. And it offers incredible depth, right? If you know to look for it and understand what the audit opinion means.
Exactly. It adds that extra dimension. But, thinking ahead, it would be really insightful maybe in a future deep dive to explore required supplementary information, that RSI we mentioned earlier.
The stuff that's mandated.
Right. Because the auditor's responsibilities are different there. It's another layer, another set of rules and procedures. Hints at, the next level of complexity in financial reporting.
Always another layer, isn't there?
Okay.
Well, that definitely gives us something to think about for the future.
For sure.
So keep digging, keep learning, and definitely stay curious. Until next time, on The Deep Dive.